Hello, welcome to IG's Trading the Markets. Today we have a very well-known guest in the city, Justin Urquhart Stewart, economist and chairman of Regionally. And he joins me now just after we got that CPI figure that was slightly softer, slightly cooler than expected, which is now bolstering hopes that the Fed might be done with its interest rate hiking campaign. But is this your reading? Do you think it's still too soon to call?
It is too soon to call. Why? Because, well, to actually understand this data, we're going to have it'll be revised next month. And also you have to look at the pattern rather than just individual months and quarters. And actually what my view is, the pattern is now becoming clearer in that I would actually say that we have reached a peak. But if the Fed thinks there's more to be squeezed, then I frankly would disagree with them. Remember, the key issue in America is actually what Joe Schmo, or more to the point, Mr. and Mrs. Joe Schmo, living in Little Rock, Arkansas, and shopping at Walmart. It depends how they are affected. Now, they've been affected by interest rate rises. And as you know, we all know that the consumer is 65% plus of the US market, the US economy. So actually putting interest rates up again now wouldn't serve any particular purpose. We have not got a consumer boom, which is what you would normally put interest rates up to try and control that inflation. This is supply side inflation and therefore doesn't need any more interest rate rises. What it needs, I'm afraid, is some more international political confidence that the economy is going to be able to grow again next year, which it will, but it'll be slower and lower.
Certainly all that feeds in, especially in the retail space, to what we've been hearing. Mixed outlook so far, most data pointing to the fact that Americans are starting to feel, quite cost conscious and trading down and perhaps not splurging as we are close to the US holiday shopping season. So with this and, a housing market that's now starting to look a bit shaky and this concern that perhaps the door isn't completely shut to yet another rate hike. Are we able, do you think, are the markets able, and governments as well, able to achieve this soft landing in 2024?
I think actually there's every chance that we would see a soft landing. However, that may change if they put interest rates up again, because I think we'll be pressing things too far. The impact on interest rate rises really impacts on businesses, smaller businesses which have got high levels of debt or private equity investments and such like. They're the ones that will have more pressure then put on them. And so interest rate rises there could be very dangerous to that area of the economy. However, I actually do think that's actually with having a slow growth economy for the time being, after all the worries that we've had over the past few years, actually is not bad. We just go back a few years ago. We had a banking crisis. We had having to deal with COVID, having to do with all the issues of geopolitical wars. And despite that, the economy global economy is growing. The American economy is growing. Just shows how robust underneath it really is. But now is the time not to be taking further risks. They've actually put interest rates back where they should have been some time ago. Remember, we've been living with emergency rates here, not low interest rates. We should have had the courage of our convictions to put them up already to where they should be. So it's there or thereabouts. And I think to avoid any, let's say, a hard landing, or more to avoid, protect the rather thin confidence of the American consumer, don't put costs up again.
Let's turn this on its head then, Justin. Do you think the Fed, and I'm just checking in on the CME Fed Watch tool, we're seeing suggestions that pricing is coming back off now, and that easing, the forecast of perhaps another hike is now easing. The odds of a hike in January slashed to 6.2%. Do you think that we should, in fact, expect perhaps a cut from the Fed instead in the coming months?
Given their current behaviour, I think it's unlikely we're going to be seeing a cut anytime soon. But I believe we will see a cut. But I suspect it may well be in the latter half of next year. That is to say, unless we're actually going to be seeing more difficulties in the economy and maybe having a hard landing. But let's assume we don't have that. Let's assume the geopolitics doesn't get in the way too much, by which I mean obviously the hideous wars we're seeing, not just in the Middle East, and of course the American election as well, which would just add other element to it, particularly when dealing with the deficit and the overall level of debt. And it is something now which is now having a greater impact on people's worries. Are we going to be able to continue to service the debt? It's not an American issue, it's a global issue. If so, how? We're going to find it difficulty. You're not having quantitative easing back again or anything like that. The bank's desperate, so the Fed's desperate to try and actually normalize the issue with American bonds and treasuries. What they want to be able to do is unload some of this, but it's got to be done very gently and steadily. So yes, next rate will, in my view, will be late next year. But fingers crossed, actually, we have a slowing economy, not a dropping economy.
And speaking of next year, where do you think the growth is going to come from? I mean, bond markets in comparison to to equities have been looking very attractive. We've got, as you said, the high energy prices, inflation still a problem. China's reopening or lack of reopening, not really stirring growth there. Where is the growth going to come from next year?
That's a wonderful list of reasons not to invest. And I've always found that actually my worst decisions have always been actually not to invest, but actually seriously look to try and find the best places to be. So where are we going to be seeing some growth? Or more to the point, where are we going to see growth which is not being held down by debt? And that means, unfortunately, a lot of the emerging economies are going to find it difficult. So that's not going to be the area. Is it going to be commodities in terms of actually still having demand coming through? It'll be there, but not as strong as before. No, there are two areas we have to look at. One is actually Chinese policy. Are they going to be able to provide more support? Remember, they've got a lot of internal issues to manage. We obviously know about the property market, which has been to a great extent sort of folded over for the time being. It's still there. There's a lot of debt behind all of that. And so are the Chinese willing to actually make sure that they will boost the economy, albeit gently? And I think what you'll find is, yes, they will. Because remember, one thing communist parties don't like having is social unrest because people's jobs are at stake. No, the Chinese will take action to try and stop that. So I think you're going to see more movement coming out of China. With a bit of luck, we'll see the American economy actually picking up a bit more if we do see not just interest rate cuts towards the end of next year, but more to the point, the change in attitude. It will give the American consumer more confidence, that vital word. If they've got confidence, then they'll move house, they'll spend all the stuff you need for a new house, and you get the economy moving again. That's the crucial area to try and look at. So I'd be looking at actually a position now of American equities, but looking at those areas who are actually going to be benefiting, or rather actually not suffering from high rates on debt, and actually those in a better position where they've got little or no debt. So I think you're going to see, some quite interesting moves as companies trying to make themselves leaner, meaner, and with less debt because of the cost of that debt has gone up too much. So you're going to see an awful lot more, I think, of debt being run down wherever they possibly can, and greater concentration on profits, probably going to things like buybacks rather than anything else.
Right, we have to leave it there. My thanks to Justin Urquhart Stewart, economist and chairman of Regionally, talking about where the growth is going to come from. He says US equities, anything that's not held back by debt, and also the prospect of a US rate cut by the end or latter half of 2024. This is IGTV.